I'm Andrew Main, Wealth Editor of The Australian, and I'm introducing the Wealth Intelligence series that we're doing in partnership with Perpetual. And my first guest is Matt Sherwood, who's the Head of Investment Market Research at Perpetual. Matt, what will the consequences be for the Australian economy when quantitative easing finally tapers off in the US?
Well, quantitative easing really is the thing which is really grappling markets at the moment, because we've had a massive run up in share prices over the past 7 months or so. And of course, just a bit of volatility recently as the Fed's trying to prepare the market for its unwinding. The way it's going to hit the economy is twofold. First of all, it's going to have an impact on the exchange rate. So quite clearly, that's going to be very favourable for the Australian currency. Now, we've already seen the dollar come off 9.5% from its April peak of 105, and so therefore that will continue to provide support for the Australian economy through the export channel. The second way it will also support the Australian economy is a more indirect one, and that is, of course, when the Fed policy is being unwound, it really is an unambiguous sign that the US Federal Reserve is comfortable with the sustainability of the US recovery. And of course, the sustainable US recovery, even though it still remains the weakest in history, is a really good foundation for markets to be working off. Obviously, there'll be eventual throw-through effects to earnings growth, which of course will, after the adjustment to the QE unwinding, that will continue to support markets. So in both ways, the Australian economy and the asset market should be supported.
So, Matt, in a way, didn't you find it kind of strange that our equity market sort of stopped in its tracks when it became apparent that quantitative easing was going to end?
Or one would be surprised about that, but when you actually think about it, it's actually quite logical, because in the end, the quantitative easing has been an enormous amount of support for global share markets, and it's driven valuations up and share prices up, even though the earnings environment hasn't dramatically improved. In fact, expected earnings in the largest 20 markets are down in 17 of them for 2013. So there hasn't been a marked improvement in the global earnings expectations. What's happened, of course, with all this cheap money flooding into financial markets, that just has meant that the markets have lifted, primarily through, as I said, the rise in valuation. So when that support base is progressively unwound, you would naturally expect that the markets would adjust downwards. But of course, that's just an adjustment process. In the longer run, markets will continue to be supported by a better earnings outlook. Even though the US economy still remains pretty subdued, the growth is sustainable, which really is the key here.
So that's a reasonably positive message all round. Obviously, the big question we've got is really looking forward with the Australian economy and the share market. And I know that you see them as two separate things, which is a very constructive point. Government policy. You're a bit concerned, are you not, that as Australia goes through these changes, there's a lot of structural inefficiencies that haven't been ironed out?
Yes, I think Australia has really, for the last 15 years or so, the last 10 years, really been living through the great complacency. So we haven't really embraced a broad reform agenda, which has been productivity enhancing. Now, we've done some things which have become more of an impediment to the economy. And so really the new government, whether it be Coalition or Labor after the September 14 election, really needs to grab this mantra, because at the moment Australia's competitive advantages are progressively being corroded away. One way that that's been done, of course, is just by the general state of the budget. Now, we are 22 years now into an economic cycle. It's the longest cycle in Australian economic history, and it's 3 times longer than the second longest cycle. That's how good things have been in this country. We've withstood a lot of turmoil in global markets. Asia financial crisis, Russia default crisis, tech bust, global financial crisis. So Australia's sailed through all of these. But what's happened more recently, of course, is the budget situation in our country has deteriorated.
Too much spending, not enough revenue.
And that's what it reflects in the end. I mean, quite clearly the government had to spend more during the global financial crisis to really hold the economy together as private demand fell away. But when the growth became, solid enough and self-sustaining in 10, 11 and 12 and now 13, they should have been cutting the expenditure a lot more than what they did. We've been living in an above trend economy for many, many years, and of course they are the times when we should be running surpluses in this country. Now, it's not possible every year, but what it is possible is that outside crises, the budget should generally be in surplus. So we need to engineer and embrace much broader tax reform. Now, quite clearly, with both parties unwilling to increase corporate tax and personal tax, then clearly the only hope for the budget in the wake of all these structural spends which have been put in there, unfunded fiscal promises, really the only hope for the side then really is indirect taxes.
Yeah, such as GST.
That's correct, and that big elephant has got to be brought into the game, because in the end we've got all these spendings going up through time, on the back of the ageing of the population, with aged care, with health care, with pensions. So really we need structural revenue. And obviously the GST really is the key component of that. And if we could just increase the GST to 15% and broaden the base to include more services, you could raise $30 to $35 billion, and that could fund a massive restructuring of the entire tax system. We could solve the welfare to work issues, we could solve the duplications between state and federal governments, and we could also initiate much broader tax reforms and get tax relief into the areas which it's needed, and at the same time, of course, being able to strengthen the budget position, which is something that obviously Australia as a net importer of capital desperately
needs to do. Matt, we've run out of time, but thank you very much indeed.
All right, thanks Andrew.